Welcome to Lesson 8. Today we are looking at volume. If the market were a car, price would be the direction we're driving, but volume would be the gas in the tank. You can turn the steering wheel all you want, but without fuel, you aren't going anywhere. Volume is the ultimate validator of every move we've studied so far. Volume represents the actual number of external orders flowing into the market. It is the raw data of human decision-making. Key rule: momentum changes before price changes. Before a trend reverses, you will almost always see a surge in volume. In day trading, we don't need a massive price swing to analyze intent. Even a one Satoshi move is enough if we compare its volume to the previous candle. We are looking for an increase or decrease in participation to tell us if a move is real or a mirage. A simple increase in volume doesn't always mean the price will skyrocket. The market's primary goal is to find a balance point, a price where buyers and sellers agree. We look for a plus or minus 10% difference as a statistically significant change in volume. Our foundation of analysis is searching for the connection between these volume changes and the resulting price action. If volume is surging but the price isn't moving, something big is happening behind the scenes. To measure this connection, we use the Money Flow Index, MFI. Don't confuse this with the standard RSI-style MFI. This is a specific calculation of market efficiency. Essentially, it measures how much bang for your buck you're getting. Is the market moving easily with little effort, or is it struggling to move despite massive volume? MFI demonstrates the market's true willingness to undergo change. By combining volume, the fuel, and MFI, the efficiency, we get four distinct market states. We categorize these as green, fading, fake, and squatting. Each combination tells a specific story about the psychological state of the traders involved. Understanding these four states is what allows us to anticipate breakouts before they happen. The green state is your green light for movement. Volume is up, new traders are entering. MFI is up, price is moving efficiently. This represents a breakout or an escape from a level. Think of it like a high-speed train that has just been given the signal to go. You cannot stand in its path. The best decision here is to follow the trend. Price movement is gaining speed because the conviction is high. Fading is the complete opposite of green. Both volume and MFI are falling. The market is taking a breath or simply losing interest. You will often see this at the peak of Wave 1, W1. There is little action, and the market impulse is tending towards zero. As a trader, this is your alert. Stagnancy is the precursor to a new impulse. When the market is quiet, it is preparing for its next move. Fake is the broker's trap. Here, MFI is increasing, so price is moving easily, but volume is falling. This is unnatural. It means the price is moving because there is no resistance, not because there is high demand. This is the trademark of manipulation. Brokers and market makers use this lack of volume to hunt your stop losses. They push the price in the opposite direction of the real move to trigger stops and build inventory for themselves. Treat a fake signal with extreme skepticism. Finally, we have squatting, the most powerful moneymaker in the system. In a squat, volume is surging, but MFI is falling. This means a massive battle is taking place between bulls and bears, but neither side can move the price. Like a tiger squatting before it leaps, this represents a huge accumulation of energy. Almost all major trends end with a squatting candle at the top or bottom. When the breakthrough finally happens, it informs us whether the trend is continuing or reversing. This is where we look for our most profitable entries. These are two examples of squatting. You can see that we have an extreme candle along with higher volume than the previous candle.